All right, today we're going to pull back the curtain on the economy. We're talking about the hidden rules that decide how businesses compete, what prices you pay, and why it feels like some industries are just impossible to break into.
And it really all starts with a simple puzzle. I mean, think about it for a second. Why is it that a corn farmer can sell to basically anyone and has thousands of competitors, but when it comes to flipping on your lights, you probably have exactly one company to choose from? What's the deal with that huge difference?
Well, the answer is a really powerful concept called market structure. It's basically the rule book for competition in any given industry. And if you understand it, you can figure out who has the power to set prices, what kind of strategies businesses will use, and yeah, who's going to make the most profit.
Now, the easiest way to think about this is on a spectrum. On one far end, you've got perfect competition. We're talking tons of sellers, and none of them have any real power over the price. And on the complete opposite end, a monopoly. Just one seller who's holding all the cards. But in between, that's where we find the really messy and honestly the most interesting stuff: monopolistic competition and oligopoly.
Okay, so let's dive in by looking at those two extremes first. It's the best way to see how just a couple of key factors can create totally different worlds for both businesses and, for us as customers.
So, the first and most obvious difference is just the sheer number of sellers. Perfect competition means there are many of them. So many, in fact, that no single one of them can really move the needle on the market. Just think about all those individual corn farmers. A monopoly, on the other hand, is exactly what it sounds like: one seller. Your local power company? That's a classic example. They are the market. And it's not just about who's selling, it's about what they're selling. In perfect competition, the product is totally identical. A bushel of corn is a bushel of corn, right? It's a commodity. But with a monopoly, the product is completely unique. I mean, there aren't any good substitutes for the water that comes out of your faucet, which is why your water company is often a government-regulated monopoly.
And all of this boils down to one crucial thing: who gets to set the price? That farmer? They have absolutely zero pricing power. They are what we call a price taker. They have to accept whatever the market price is that day. But the monopolist? They have considerable power. They're a price maker, and those big profits they can earn can sometimes be used to fund some really big innovations.
All right, so let's move away from the extremes and into the middle of that spectrum, because this is where things get really interesting. This is where most of the brands and businesses you and I deal with every single day actually live and compete. So first up is something called monopolistic competition, and the name itself kind of gives it away. It's a hybrid. Just like perfect competition, there are a whole lot of sellers. But the key difference, the entire game they're playing, is all about one thing: making their product seem different from everyone else's.
So how do they pull this off? Well, through everything from massive ad campaigns and unique styling to building these incredibly powerful brands. The whole point is to convince you that their product isn't just another choice, it's the choice, right? Coca-Cola isn't just selling you soda, they're selling you a feeling. Harley-Davidson isn't just selling motorcycles, they're selling an entire identity. They basically create a little mini monopoly right inside your head. It gives us tons of choice, which is great, but it also means prices are a bit higher.
Okay, so while some markets have tons of firms all trying to stand out, other markets are dominated by just a few giants. And that's what we call an oligopoly. In this world, the whole market is controlled by a small handful of huge firms. And this creates this fascinating, tense dynamic where they are all interdependent. It's like a high-stakes chess match where every single move a company makes is based on how they think their rivals are going to react. And this interdependence leads to some really unique behavior when it comes to prices. Think about airlines. If one airline drops its prices, what do the others do? They almost always match that price cut immediately because they can't afford to lose passengers. But what if that same airline raises its prices? The other airlines will probably just ignore it, hoping to steal away customers with their now cheaper fares. Economists have a name for this: the kinked demand curve, and it's the reason why prices in these markets can feel surprisingly stable, even when the competition is fierce. So you might be thinking, okay, this is some interesting economic theory, but here's the thing. This isn't just abstract stuff. These market structures have a very real, very direct impact on your everyday life, on the choices you have, and on the money in your wallet. Seriously, think about it. The price of your plane ticket, how many different smartphone brands you can choose from, even how fast new medicines get developed. It is all shaped by the market structure underneath. More competition usually means lower prices for us, but sometimes less competition means bigger profits that can be used to fund that next game-changing breakthrough. And because the stakes are so high,
You better believe that government regulators are keeping a really close eye on how concentrated or, uncompetitive a market is becoming. They actually have special tools they use to measure this and to decide when they need to step in and do something about it. And one of their main tools is called the Herfindahl-Hirschman Index, or HHI for short. I know, it sounds super complicated, but the idea is actually pretty simple. You take the market share of every company in an industry, you square those numbers, and then you just add them all up. A low HHI score means you've got a really competitive market. A high HHI score is a warning that a market might be dominated by just a few big players.
And this is where the HHI becomes a really big deal. Let's say two big companies in the same market want to merge. Well, that merger could cause the HHI score to jump way up, just like you see on this chart. A big leap like that is a huge red flag for regulators. It signals that this deal could seriously reduce competition, and that could end up hurting consumers like you and me.
Which brings us to this really fundamental trade-off at the heart of this whole thing. On one hand, perfect competition seems great for us in the short term, right? It gets us the most stuff at the cheapest price. But is that the whole story?
So we're left with this big question. What's the perfect balance here? Do we want that cutthroat, efficient competition that gives us low prices today? Or do we actually need the massive profits that come from less competitive markets to fund the risky, expensive innovations that are going to push all of society forward tomorrow? As you can see, the answer is, well, it's not so simple.